Hey, welcome back, everybody. And this is Ken Himmler, and you are in part two of part five of how to reduce or eliminate your capital gains tax. Hey, before I get into this, you might ask, well, why should I subscribe and get notified to this channel? Well, two reasons. One is because then you'll know when the next parts of this particular video are coming out. And number two is as we grow this channel, this increases our reach. And you might ask, well, how does that affect me? It does, because the more we have to put towards production, the more information I can get to you. So if you'll subscribe and notify, I promise the next episode, part of this, part 3, 4, and 5, you're going to get notified so that you can make sure that you're in the know. Before we get started, I want to explain why it's important to reduce your capital gains tax. Capital gains are not as low as most people might think. Some people think, well, I only have 0%, 10%. If you join part one, you might think, hey, I can zero out my capital gains tax. You might be able to do that. Not everybody has that ability to do that and switch and flip different income sources to get down to that 0%. So today, I'm going to talk about how to reduce or eliminate the capital gains tax using basis laddering. Now, why aren't you being told this by your financial planner, by your financial advisor, by your accountant? There is this disparity that people have in this community of you go to see your accountant, you bring them what has already happened, they prepare your tax returns. You go to the financial advisor, the financial planner, they work for some big brokerage company, a financial planning firm, and they tell you right out of the gate, we cannot advise you on taxes, which is kind of a catch-22 because if they're calling themselves wealth managers, I would assume that they can encompass everything wealth management. But unfortunately, big companies don't want their advisors who are not trained in tax to give tax advice. Makes sense. But here's why you need to know this. If you are taking the risk, a high risk investment, let's say you develop a targeted portfolio to target 10 to 12% rate of return per year. And let's say that you let that gain accumulate. And now you've doubled your money, maybe tripled your money over a 10-year period. You go to sell it. If you don't have these techniques down, you will lose a quarter to a half of all of your profits. So you step back and say, well, wait a minute. If I am taking this kind of risk, but I'm only netting what a guaranteed investment would do, what's the point of taking the risk? So if, as an example, you targeted 10%, but you netted 5 because you didn't tax plan, heck, for that matter, you could go take it and throw it into some, and I'm not telling you to do this, you could throw it into a T-bill, T-note, even an annuity, and probably net 5%. The goal is to, if you're going to target a 10, 11, 12% rate of return, have the techniques down so that you're netting as much as you can. I won't say that you can always eliminate the capital gains tax, but with these techniques that I'm teaching you, you can certainly grossly reduce the amount of tax that is due. So without further ado, today we're going to talk about basis laddering. Basis laddering. So let's talk about how that actually works. And why is basis laddering even there? Where is the problem? Well, the problem is that people think deferral is a great idea. It's a great idea for the IRS and Congress and the tax revenues, but it's not a great idea to defer everything. Why? We live in a world of progressive tax rates. That means that the higher that you earn, or the more you earn, the higher the tax bracket that you pay. So if you think through tax planning and how to hold on to more of your money, it's not to take large lump sums or large gains in any one year. It's to minimize those along the way. And that's what basis laddering is really all about. Unfortunately, financial advisors, financial planners, and accountants fail on this because they talk about the greatness of deferral, like with IRAs and 401ks, and that only causes a bigger tax time bomb at a later time. So deferral is not always the best way to answer things. So because if you have too much of a gain, there's no way to overcome that in one given year. Now, I will talk about 664 trusts in the next parts. That is a potential, but it doesn't fit everybody. So let me use one example of that, and we're going to use Microsoft. Had you bought Microsoft September 1st, 2005, let's say you bought 1,000 shares at $26,000. Today, you'd have a nice little gain, $427,000 for a net gain of $401,000. If you want to sell out of Microsoft stock, how do you do that? You sell it all and then take that $400,000 gain? Because the problem is that's going to throw off all your numbers. You're not going to get that at a 15% tax rate. You probably won't even get that at the 20% tax rate. So had the basis been laddered and every year you're using this technique I'm about to teach you, your current value could have been $427,000, but your tax would have been zero. So let's talk about how this actually works. So we can even do it with real estate. So real estate, let's assume you purchased a building in 2007 for, let's just say, $1 million. And let's say that the current value is $3.3 million. Well, this makes the presumption that you got a 7% rate of return over the last 10 years, or since 2007. Now, has real estate always performed at 7%? No, it's a little bit better than 5% over the last 50 or 60 years. But since 2007, those people that invested in the right locations did a little bit better than 7% rate of return. So in this example, you'd have a $3.3 million property with a $2.3 million gain. That's a pretty big gain that it's going to be hard to wash that bugger out all in 1 year. Now assume you did basis laddering, and you can do basis laddering on real estate using stock. And this is where most financial planners, financial advisors, and certainly accountants fail. They keep talking about all the benefits of deferral until you have to sell, and then it's a big problem. Had you used upping basis, you wouldn't even have to do a 1031 exchange. You know, that's always everybody's out. Well, use a Delaware statutory trust, but you're still back in real estate. Use a 1031 exchange. You're still back in real estate, but you still have the management. Most of the time that people sell out of real estate, it is because they don't want to be in the management game anymore. So a 1031 exchange is not really going to work. So you can either use a trust or an LLC, and by using basis laddering techniques, using the same example after a 10-year period of time, you could sell the property to a LLC or a trust. Now, for all of you that are creative minded and you think, hey, that's a pretty good idea because now I could reset my basis and I could reset my depreciation. Bad news is you can reset the basis so that you could sell the property and eliminate the gain, but you cannot reset the depreciation. Selling to a related party, and if you created such a trust as I'm talking about, or you created such an LLC that I'm talking about, a related party is that you created it and essentially you're selling it to yourself. Now, the funny part about this is they won't let you reset the depreciation, but the government is more than happy that if you want to sell it to a related party, you can book the gain. Yeah, they'll take the gain. They just don't want to give you the benefit of resetting the depreciation. So you can't do that. Anyway, resetting the basis. Let's talk about how this actually could work for you. And why do you want to do it? Well, when you have capital assets, and let's say we use the S&P 500. Now, long-term average rate of return, a little bit better than 11%, certainly better than gold at 5 or 6%, certainly better than real estate at 6 or 7%. So long-term, this is why Warren Buffett is one of the richest people in the world. He's just used capital assets over a long period of time. But if you keep deferring it, well, let's look at what happens. If I take $1 million and I invest it at an average rate of return of 11%, the value in 10 years is $2.865 million. So you go to sell out of one stock or multiple stocks, and you're looking at a massive gain that's going to be very hard to fit into any kind of tax reduction strategy. Not all, but most. So you're definitely not going to fit in the 0% tax bracket. And unfortunately, you're going to go up from the 0 to 15% rate bracket up to the highest 20%, but it's not really 20%. It's actually 23.8. In addition, there's what's called hidden trigger taxes. What are hidden trigger taxes? These are taxes when the government comes out to you and they say, "Hey, we're gonna reduce your capital gains tax rate." I love it. I don't care what politician has done this. Well, maybe there's one politician that I didn't see the net negative effect, but every other politician in my 40 years, so I don't know how many presidents have I been through, 6 or 7 or something like that. Every one of them comes out and says, "Hey, we're going to lower your taxes." You're looking at the guy that's doing the tax returns. And so when you get through all the IRS formulas, those what you believe or what the politicians tell you they're reducing taxes, they're not. They're actually increasing taxes because you have the NIT tax, you have the Medicare penalty tax, you have alternative minimum tax, and then you have your state. Some states impose the capital gains, some don't. But if you have all those taxes, I mean, you could be looking at 40% in capital gains, which again kind of negates the whole beauty or I'd say propagated beauty of deferral. So let's look at the cost of deferring the gains. If I have taxable income, it's going to potentially trigger these higher tax rates: Social Security tax, net investment income tax penalty, Medicare penalty. That is a big one. That could reach upwards of $9, $10, $12,000 a year in additional penalty. And here's the bugger of it: when you create a capital gain and you get into what's called the Medicare penalty tax, IRMA, they look back 2 years and then they penalize you. And then that penalty sometimes stays on and you got to fight for it to come off because we've noticed a lot of delays and Social Security doesn't always communicate very well with the IRS. And that's where that money is coming out of. So you have also a higher tax rate federal and you have a higher tax rate state. So now let's actually talk about how it's actually done and you can see it. So I'm going to give this to you in steps. And so step one is you sell all the investments that you have substantial losses. Are you going to sell something for a $50 loss? No, not at all. But if you have a well-diversified portfolio, and what I'm talking about is at least 40 or 50 investments, there most likely will be 10 that are at a loss, 10 that are at a massive gain, and 30 that are kind of just treading water. If you have that kind of portfolio, you're actually doing pretty well because that's what major money managers, major hedge funds, they all deal on that 10, 10, 30 rule. So you sell the losers. Now you calculate the losses. If you followed me in part one, I went through the exercise of how to calculate short-term against long-term losses. So you want to then, if you want those same investments, now they may just be down because of market cycles. And you might say to yourself, well, I want to make sure that I am not out of the investment. So you could buy something that's similar. An example would be you sell the S&P 500 and you buy the Russell 1000. Okay. If you do that, they're similar enough where they're tracking a lot of the same markets, the fluctuations, ups and downs, but they're different enough that you're not going to get caught in the disallowed loss under what's called the 31-day loss rule, which means you can't sell something and then immediately buy it back, at least within the first 31 days, and then be able to take the loss. Okay, so step two is you're going to calculate your loss. Step three is you're going to look at the investments that you want to hold long term. So in step one, you might be paring out some of the junk, or you might have some good stuff. It's just down due to cycles. But let's assume that you want to look at the investments that you want to hold long term. So how do you ladder up your basis? What you do is you sell those good investments that you want to hold long term, enter a limit order to immediately buy them back. Now, thing is, you don't have a 31-day gain rule. You sell something and buy it back, you're going to book the gain, which is what you're trying to do. I know it sounds odd, but what you're trying to do is you're trying to up the basis. So little by little by little, you're knocking away or chipping away at that deferred gain so it doesn't defer too much. Okay, so again, you're going to sell it, but you're going to offset it with the losses that you took in step one. Then you have 0% tax. So this is called basis laddering. And again, you can do this with real estate, you can do it with stock, you can do it with stock against real estate, you can do it with real estate against stock. So in part three, I'm going to kind of continue this methodology, this journey of talking about how to do pure loss harvesting. This stop, and I'm also going to talk about stopping the double taxation that you get by holding a stock in an IRA. That's right, I said it. If you hold an equity in an IRA, 401k, or retirement plan, you are literally doubling the tax on it. And I will show you exactly how to eliminate that problem. And I'm also going to show you how to do what's called a Roth conversion swap. And again, if you just click on subscribe and notify, the little bell will let you know, it'll let you know as soon as I come out with part three. Hey, thanks for joining. Hopefully you're getting some out of this. If you like what you're hearing and I'm educating you, go ahead and click on that like. We appreciate it. Have a good one.